All right, Wolf Street, Wolf Richter. You know, you look at all these stocks and stuff, and they're going up, and the main market, the S&P, the Dow. Of course, there's plenty that are getting crapped on. But even like with banks and some of these big companies, there's something that you never used to hear about, and that was share buybacks, where a company that has shares, public, they IPO'd, they have their shares, they've been around for a long time, whatever, and their price is going up, and people are selling off their shares. And rather than not do anything, the company decides we'll buy those shares. So if we buy them, we'll be able to keep the share cost or the price of the share higher. If we don't step in, regular market forces will be there, and our stock's going to go down. There'll be people selling with not enough people buying, our price is going to go down. So what we're going to do is we'll go do share buybacks. And with all this free money that all these big corporations and banks got, especially the banks, why not? You got a bunch of money at 0% interest rate. You could use it for anything you'd like. So here's this article. Mega banks blow 100% of earnings on share buybacks in dividends, crimp lending, constrain economy. The real economy has little to gain and much to lose. When tighter regulations were imposed on the banks after the financial crisis, the largest among them, the very ones that threatened to bring down the financial system, began squealing. Those voices are now being heard by Congress, which is considering deregulating the banks again. In particular, they claim that current capital requirements force banks to curtail their lending to businesses and consumers and thus hurt the economy. Nonsense. That's in essence what FDIC Vice Chairman Thomas Honig told Senate Banking Committee Chairman Mike Crapo, or is that Crapo? Crapo. And the committee's senior Democrat, Sherrod Brown, in a letter dated Tuesday, according to Reuters. The senators are trying to find a compromise on bank regulation. If banks wanted to increase lending, they could easily do so without lower capital requirements, Honig pointed out. Rather than blowing their income on share buybacks or paying it out in form of dividends, banks could retain more of their income, thus adding it to regulatory capital. Capital absorbs the losses from bad loans. Higher capital levels make a bank more resilient during the next crisis. If there isn't enough capital, the bank collapses and gets bailed out. But banks that increase their capital levels through retained earnings are stronger and can lend more. Alas, in the first quarter, the 10 largest bank holding companies in the U.S. plowed over 100% of their earnings into share buybacks and dividends, he wrote. If they had retained more of their income, they could have boosted lending by $1 trillion. So my question is, why are they spending so much money on share buybacks? Let the quote-unquote market work that one out. Yeah, but then our value of our stock goes down. And the executives and the CEO and the CFO and the COO and all the shareholders, we lose. And you know how much money I have as the president or a member of the board in this company? I need that stock price to stay high. Keep doing those share buybacks. How about you don't? If you're so concerned about lending, why the hell are you spending the money on your own shares? I'll be honest, I think that should be legal. How can a company buy its own damn shares? That just to me seems illegal. It should be illegal. Speaking of the 10 largest banks, guess who number one is on the share buyback stuff? But by assets in billions. JP Morgan, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, Morgan Stanley, US Bancorp, PNC Financial, TD Group, Capital One. You know, the too big to fail club. The CEO of the top bank on this list, JP Morgan, that would be Jamie Dimon, has been very vocal about plowing more of the bank's income into share buybacks and dividends while pushing regulators to lower capital requirements. In his Dear Fellow Shareholders letter in April, Jamie Dimon wrote, under the heading Regulatory Reform, among other things, many other things, it is clear that the banks have too much capital, and we think it's clear that banks can use more of their capital to finance the economy without sacrificing safety and soundness. Had they been less afraid of potential CCAR stress losses, banks probably would have been more aggressive in making some small business loans, lower rated middle market loans, and near prime mortgages. But the government was preventing them from doing it, he suggested. This didn't sit well with Honig, apparently. He was president of the Kansas City Fed and member of the Fed's policy-setting Federal Open Market Committee from 1991 to 2011 through the financial crisis. Observers of the Fed remember him wistfully as one of the rare hawks on inflation, and in his function at the FDIC, he's not shy about being a thorn in the side of the biggest banks, though he is outclassed by the power of the biggest bank regulator, the Fed, which has a much more accommodating view of bank regulation. So Honig supplied some numbers in his letter. The largest bank on his list is JP Morgan Chase, earned $26 billion over the 4 quarters, but it plowed $27.6 billion, or 106% of its income, into share buybacks and dividends. If it had retained that income, it would have raised its capital by that amount, and it would have been enough to make an additional $250 billion of loans under current capital rules. In total, the 10 largest banks combined, on an annualized basis, will plow 99% of their earnings into share buybacks and dividends. Share buybacks alone amount to $83 billion, not counting dividends, under existing capital rules. If the banks were to retain this capital instead of buying their own shares with it, they could have increased commercial and consumer loans by $741 billion. And they could have still paid out their big dividends. If they cut their dividend payments some, they could have boosted their lending by over $1 trillion. Quote, I can only caution against relaxing current capital requirements and allowing the largest banks to increase their already high leverage position, Honig wrote. The real economy has little to gain and much to lose by doing so. While distributing all of today's income to shareholders may be received well in the short run, it can undermine their future returns and weaken the growth outlook for the larger economy, he wrote. I recognize that dividends are an important factor for investors, and they should be rewarded for the risk they take, but it is also true that funding business growth, assuring future economic success, and promoting capitalism depend upon the retention of earnings, he wrote. What is it that makes me think that his reasoning and pleas will once again fall on deaf ears? Is it the fact that the banks, including Goldman Sachs, have aggressively schmoozed with Congress and staffed essential parts of the administration? Something tells me that Honig will once again be shunted to a sidetrack and forgotten. And the number 3 on the list, Wells Fargo, is now in the middle of a new scandal, which I've told you about the other day. Another 570,000 or 800,000 customers become victims. Read, it just doesn't let up with Wells Fargo, as he posts a link here. And I have to agree. Wells Fargo should be shut down. Completely dismantled. And I don't care if you break it up and give it to the too big to fail bank. Give it to them. Break that sucker up. They were charging fees, insurance, car insurance, on top of the loan that they gave people for the car. And basically the person could get their own car insurance, but sometimes the bank would kind of forget to take the fee off. So they were asking them to basically pay their own car insurance, pay the car loan, and pay additional car insurance that they provided, that the bank provided. That's Wells Fargo. And it was hundreds of thousands of people. Yeah, we found that out in 2016. And like 25,000 people, I think that was the number if I recall. I may not know this exactly. But I want to say like 25,000 people or more, somewhere around there, got their car repossessed because they couldn't afford to make the payments. And of those, they were talking about people, you guys were paying the fee. You guys were paying the extra fee. So the car is long gone. It went to an auction. It went and sold. All right, so what do you do? As a consumer, now you got to file a lawsuit. Oh, we'll do a class action. How about that? I bet we'll get, I bet you'll get something back. I bet your credit will come back. You might be able to get your credit back. You might be able to fix that part. But who the hell wants to deal with this stuff? And my question is, how are there so many people, 500-something thousand, that didn't know, hey, this is what my car payment is supposed to be, and here's what they're charging me? And didn't call in and say, hey, I've got the paperwork that I signed. Here's the monthly payment right here. I've got the paperwork. Why am I paying an additional $100-something a month? Or 80 or 60, whatever it is, depending on the kind of car, how old you are. How come nobody's questioning this? Because everyone's on drugs, pharmaceuticals, we're on everything. And even if you're not, even if you're one of the people like me, my family, we're not, is the water that we're all drinking safe? Well, no, because all those people who piss in the toilet and all their pharmaceuticals come out of them and it goes back to the water treatment plant and they do their thing on it. It comes back to your house and you put it back in your mouth somehow. Contains trace amounts of all these things. But it's not just trace amounts of one thing. It's trace amounts of this, trace amounts of that, trace amounts of these things, trace amounts of... So when I tell you I'm on this little property here and I've got a well and a water softener and a filter in the refrigerator, that's actually a good, really good one. And I'm going, as you're seeing this video, I'll probably be at the old house getting my reverse osmosis unit out of that sucker to bring over here. And at least I can tap that well water. And I told my wife, I was like, because of where the refrigerator's at, I can't really hook this reverse osmosis up to it. Because the water sink is right in the middle, like this little island, in the kitchen. So I'm not about to destroy, the floor to try to get into there or whatever. So I'm like, that's okay. We'll just have the reverse osmosis right here at the sink, like you normally would put it. And the regular refrigerator will be right there. It'll have the filtered water, which won't be nearly as filtered as reverse osmosis, of course, but at least I'm on well. It's going through some filters out in the little well house. One of them is a water softener, and I think an iron filter, which isn't really going to pull bad stuff out of the water per se. But then it goes in the house, goes in the fridge. In the fridge, it does have a pretty nice filter. So I felt like, okay, we'll use the ice from that mixed with the reverse osmosis water in a cup to get some of the nutrients and things out of the water that the reverse osmosis unit might be stripping out, kind of offset that. So that's what I'll be doing probably while you're watching this video or listening to it. Take care, my friends. Be an interesting week to see where the cryptos lie, where they're going to head next. I think 300 is literally right around the corner again. And I told everybody, look, when they smash them and stuff, just relax. I've said this 2 or 3 times. Just relax. It'll recover. It'll be right back up where it left off. Trust me, it's going to happen. It already has numerous times. Don't worry. And I still stand by that. So